You can predict the earnings number perfectly and get the stock direction exactly right, yet still lose 50% of your investment instantly. This phenomenon is called IV crush. Before earnings, option prices inflate drastically due to uncertainty. The moment the news is released, that uncertainty vanishes and the premium evaporates from both calls and puts simultaneously. So the solution seems obvious. Just sell options to collect that inflated premium, right? This is the trap that bankrupts beginners. If you sell a naked option and the stock makes a massive, unexpected move, say 20%, your losses are theoretically infinite. You need to cap your risk while still capturing the volatility drop. Enter the Iron Condor. This strategy allows you to profit if the stock stays within a specific range. You sell the expensive options to capture the crush, but buy cheaper outer options to strictly define your maximum loss. But execution is everything. Implied volatility peaks exactly at the closing bell before the announcement. Entering the trade, even a few hours too early, means missing out on the highest premiums of the quarter. Finally, to set your strikes, calculate the market maker move. This formula tells you exactly how much the market expects the stock to move. Place your short strikes outside this range to put the statistical probability of profit in your favor. Stop gambling on direction and start trading the volatility crush.